We're still not out of the woods after the financial crisis, and those who are hoping for growth in Europe will just have to wait a bit longer. So says the World Bank in its latest report on the global economy. Once again, the bank has cut its growth projections. The outlook is gloomy for developed economies in general and the Eurozone in particular. My guest in the business interview this week is the lead author of the World Bank's Global Economic Prospects, Andrew Burns. So, welcome to the program.
Oh, it's great to be here.
Now, why have you once again come out to cut your growth projections for the next couple of years?
Well, I think the downgrading in the growth projections that we see is mainly a reflection of things that have already happened. We've had a much weaker second quarter, a weak third and fourth quarter in 2012, and that's really pushed back in time the recovery that we were expecting half a year ago into 2013. So it's not so much that our expectations for the global economy have changed. We've just felt that the recovery is going to be a little bit slower to come on board.
So, in a nutshell, how would you describe the global economy at this stage?
Well, the economy right now is going through a very difficult period. We have high-income countries grew only 1.3% last year in 2012. We expect them to do only 1.3% again in 2013. So that's going to be a difficult thing to deal with. In the U.S., we expect growth to slow a little bit because of the fiscal consolidation in there. In in the euro area, we expect growth to start picking up during the course of the year, but nevertheless, growth for the whole year will be slightly negative at minus 0.1%.
So, we're still facing a contraction in this part of the world.
In this part of the world, absolutely. In developing countries, they've not been immune to that weakness in high-income countries. 2012 growth was 5.1%. We expect that to pick up to about 5.5%, but still well off the growth rates that we've been observing in the 2006-2007 period.
Now, in your last couple of reports on the global economy, you've come out to cut your growth projections, and then you've cut them again, and then you've cut them again.
Yeah.
Have we reached the bottom of the barrel this time around? Is it upwards from here when it comes to global growth?
Well, I think so. I mean, we're at a very different stage than we were, say, a year ago. A year ago, we were looking at a lot of downside risk. We were looking at sort of potentially very serious downside risks in the euro area, but also elsewhere. Now we see the risk situation much more balanced. We think that the likelihood of a crisis in the euro area has diminished. And we think that even if there were to be an increase in tensions in the euro area, their impact would be a lot smaller than we thought it might have been a year ago. So the downsides are less severe, and now there's some upsides, which frankly a year ago were relatively difficult to find. In the United States, for example, we see that the housing sector is starting to rebound. That's a potential positive for growth there. We see labor market behaving very healthily. Those are positives. In the euro area, we see that right now there's so much pessimism and so much sort of skepticism built into the baseline that there too there's room for improvement. Also, what's happened on financial markets is not to be discounted. There's been a huge improvement in terms of risk perceptions, a lowering of interest rates, and all of that should make the road ahead a little bit easier.
Now, at the World Bank, you have a special eye at developing economies in particular. How then are they faring in this climate?
Well, in a classic economist answer, I'll say on the one hand, they're doing really well. They've got 5.1% growth last year. That compares very favorably to what we saw in the 1970s, 1980s. But if you compare it with the late 2007s, it's about 1 or 2 percentage points slower. So pretty good in a long-term perspective, not as good as in the past. The question is, how do you do better? And legitimately, developing countries are asking themselves, how can we get back to those strong growth rates?
And what is the answer to that?
Well, the answer to that is that there is no easy answer to that. That acceleration in growth that we saw in developing countries was a result of strong policy changes that were made over a long period of time, strong macroeconomic policies, reducing deficits, was also investments in infrastructure, in their populations, in healthcare, all of those kinds of structural policies that take a long time to react. Our concern is a little bit in the financial crisis. They've taken the eye off the ball somewhat, been focusing too much on a reactive policy. Now's the time to get back to those long-term growth fundamentals.
I suppose we need to make a difference between emerging markets or emerging economies and emerging economies, because in 2012 we still saw very strong growth figures in China, for instance, despite the fact that growth came down somewhat, whereas in Brazil growth largely fizzled out towards the end of 2012. What emerging economies are doing well, and what emerging economies are doing not so well?
Well, the story is always, you talk about emerging economies, you're talking about some 200 different economies, so it's a very
It's
complicated
a very
mess.
broad brushstroke.
Absolutely. So what we saw in 2012 is some of the big middle income countries, the BRIC economies, they slowed down. They slowed down partly because of what was happening in the high income world, but also because of domestic considerations. They rebounded so strongly in the post-crisis period that it actually started bumping up against capacity constraints. Inflation started rising, so they tightened their own policy, and that contributed to the slowing of growth in 2012. As we come now to the end of 2012, the beginning of 2013, we're seeing growth in those economies start to pick up again. China, its industrial production is currently growing at 11.7% at an annualized pace. We expect their GDP numbers, which should come out later this week, will also be very strong. So there's a definite recovery. It's a little more delayed, but we're seeing evidence of that also in Brazil and India. So we're seeing that in those economies. Strikingly, though, is that the story in, say, sub-Saharan Africa has actually been stronger than these leading lights, if you wish. There, if you take South Africa out of the equation, those economies have been growing by almost 6% in 2012.
But they are moving off a much lower base, right?
But they're moving off a lower base, but that doesn't obviate the benefits of having that strong growth. That's how you get poverty down. That's how you make progress, and they certainly have been achieving that of late.
You have previously warned developing economies, though, from adverse shocks coming from the developed world. Seeing what you're saying about the Eurozone and perhaps that the risks in the Eurozone have come down, does that mean that the risks for developing economies from the developed world have also come down?
Well, I think the risks as a whole, the risk of a very serious negative downturn has declined. We've talked about that for the Euro area. That's true also for the United States, another area that we're looking at concerns about getting that fiscal policy in that part of the world back onto a sustainable track. So those risks have declined, but they remain, and developing countries need to ensure that they have a fiscal policy stance that is able to react in as successful a fashion as it did in 2007. So that is indeed one of our concerns.
Now, you say that some risks remain. What are you, Andrew Burns, going to be watching in 2013? What's your number one risk factor, if you will?
The risks that we're looking at are obviously the Euro area, although we see that as less serious a problem as it has been in the past. We're watching the fiscal negotiations of the United States, whether that debt ceiling gets extended for a short period of time or whether actually concrete progress is made to strengthen the fiscal sustainability in the U.S. We're watching Japan as well. Japan is particularly weak at the moment. There is a conflict going on with China that is cutting into production there. That's of concern. We're also looking at China. China is an economy that's doing very well currently, has recovered from the slowdown that we observed at the beginning of 2012. But nevertheless, it's one that faces a medium-term challenge of restructuring its economic growth, which has been initially export-led and very heavy export emphasis, most recently been focused on an investment-led strategy. It needs to rebalance that towards a more consumption and service-oriented growth.
In the past few years, we've had a lot of talk about how emerging economies are decoupling from developed economies, that perhaps the emerging economies, if not now, then in the future, that they will be ready to go it alone, that they will be able to provide their own domestic growth. How far do you think we are from that situation?
I don't think we're very far at all. In fact, I think if you look at what's happened over the last 3 or 4 years, there's pretty strong evidence that we're there. Going into the crisis, developing countries were growing 6-7%. They went into the crisis. They were hit by it very strongly. So there is a linkage between high-income countries and developing countries. It's not that they escaped unscathed. but they rebounded relatively quickly, and they have reestablished these relatively strong growth rates, 5.5%. Our forecast coming up to 6% by 2015. So that's an indication of that they're doing that, notwithstanding the fact that high income countries are struggling still
But
very
we are
much.
still seeing, though, a lot of linkages between these two worlds, right?
But that's actually exactly the point. So for us, the decoupling story was somewhat overstated. It's more a question there's been a decoupling in the trend growth rates of developing countries. So they've moved from a trend growth rate of about 3% in the 1990s up to a trend growth rate close to 6% currently. That's a sort of fundamental change. It is a reflection of them being able to go it alone, to use your words. But it doesn't mean that somehow they're disconnected from the world economy. Rather, quite the contrary.
Hmm.
They've increased their trade linkages, they're increasing their financial linkages. And as a result, when growth slows in the high income world, it slows in the developing countries. By the same token, when growth in the developing countries accelerates, as it's doing, then that helps to bring along the high income countries. So we're in a situation now for some 3 years where developing countries have been responsible for more than 50, well, in close to or more than 50% of overall growth.
And that is going to continue in the foreseeable future?
That's going to continue for some time. It's not a long-term result because eventually high-income countries are going to start growing at a stronger pace, and as a result, the developing countries' contribution will decline, even though they will likely be growing stronger.
All right. Unfortunately, we have run out of time. Andrew Burns from the World Bank, thanks very much indeed for taking the time to speak to us.
It's been a great pleasure. Thank you.
All right. With that, we're also going to be wrapping up the program. Thanks for watching France 24. Do stay with us. We have more news coming your way.